Hello everyone, welcome to eFinancial Models channel, and for today, we are going to have a walkthrough about the Gordon Growth Valuation and how does this method work. Before we delve to the discussion all, please subscribe to our YouTube channel, hit the notification bell so you can be updated on our latest upload. Today, we are going to talk about what is Gordon Growth Valuation Method, and later on, I will show you how to calculate it in Microsoft Excel. The Gordon Growth Valuation Method values companies based on annual income stream until eternity by taking into account a company's growth rate. There are two ways on how the Gordon Growth works. Number one, in valuing a company based on their future dividend income stream. Number two, in valuing a company via DCF method. In a DCF valuation, we use the Gordon Growth Valuation technique to estimate the terminal value. Okay, let's go over the Excel file and see how to calculate the value per share in action using the Gordon Growth formula. So here's the formula for the Gordon Growth. P is equals to D1 over R minus G. Okay, take note that in this example, the growth rate, dividend 0 or the last share dividend, as well as the required rate of return or the discount rate are already given. All these values written in blue font means that they are assumptions, and the ones written in black font are the ones that we are going to calculate. You will notice that the value for D1 is missing. So this is the first calculation that we are going to do. Go to the formula bar and type in the formula. Start with an equal sign, E4 or the last share dividend, followed by an asterisk or a multiplication sign, followed by an open parenthesis 1 plus the value of growth rate. Close parenthesis, then press enter. So our dividend 1 is equals to $5.45. Now that we have the value for D1, we can already calculate the value per share using the Gordon Growth formula. We start by inputting an equal sign, followed by clicking the cell B9, and then slash or the division sign, parenthesis, click the rate of return or the discount rate, B5 minus B6 or the growth rate, close parenthesis, then press enter. So our value per stock or value per share is equals to $68.13. Now let us go to the comparison part. You need to input the calculated value per share, or you can just copy and paste it. As you can see, we have here the upside potential. So to calculate its value, we need the value of the stock market price, which is already given, and the value per stock, which we calculated a while ago. So you have to go to the formula bar and input the values. So we have here equal sign, then click the cell B14 or the value per share, followed by a slash or a division sign, and then B13 or the stock market price minus 1, and then press enter to see the answer. So our upside potential is equals to 13.5%. The Gordon Growth Valuation is commonly used by matured companies or established businesses as their cash flows are already stable and tested in time. The Gordon Growth model can also be used to calculate the terminal value in a discounted cash flow valuation or DCF. Terminal value refers to the estimated value of a business beyond the projected forecast period of DCF. To calculate the terminal value, we need to complete the first part by calculating first the free cash flows for each year. We start by inputting the formula in the formula bar, starting with an equal sign, and look for the previous year's FCF value. So, click C8 Then put an asterisk or multiplication sign, open parenthesis 1 plus B6 or the growth rate for the year. So to be able to compute for the rest of the free cash flows, so you can just drag it to the right to automatically get the answer for the other year. Now that the elements to compute the terminal value are already given and calculated, let's calculate the terminal value. So we start by inputting equal sign H8 dash open parenthesis C12 minus H6. And then press enter to see the answer. So as you can see, we have the terminal value. So here are your discounted cash flow values. So to compute for the net present value, you just have to sum up all the discounted free cash flows. So just like this. So you just have to follow this formula. Okay, you can just drag it along. Okay, so the equity value is the value that remains for the shareholders after all debts had been paid. And that's it. I hope that you learned something from our short tutorial. If you find this video helpful, don't forget to subscribe to our YouTube channel and please visit our website at www.efinancialmodels.com. See you on our next upload.